Hi there, this is Mike Kramer of Mott Capital. Today is May 14th, and it's around 6:30 New York time. So tomorrow in the US, we're going to be getting the all-important April CPI report. That's expected to come at 8:30 in the morning. Analyst expectations are for a 0.4% increase month over month. That would be in line with last month's reading. Ex-food and energy, we're looking for a 0.3% increase, down from 0.4%. CPI year over year, we're looking for a decline to 3.4% year over year from 3.5%. Ex-food and energy, we're looking for 3.6%, down from 3.8%. Also tomorrow morning, we'll be getting the retail sales data. We're looking for it to increase by 0.4%, down from 0.7%. And then, of course, on Thursday, we'll get initial jobless claims. We're looking for 220,000. Also on Thursday, we'll be getting import-export prices to finish up this week's slew of data that we're going to be getting. Basically, when we start off with just U.S. markets, you can see interest rates have basically just been trending sideways since we had that Fed meeting and then the job report, which came in a little bit weaker on the headline at least. And so now at this point, the two-year rate's at a pretty critical level because while I had been thinking rates were going to go higher, the job report clearly sort of set expectations. Today's PPI report didn't really reveal very much that was new. And right now, the two-year is on the cusp of a breakdown. Should it break this trend line, it would set up a retest of 475. A break of 475 would obviously begin to set up a broken uptrend and a further decline to around 450 or so. Again, the 50-day moving average is another area that could also offer some support. Generally speaking, there's been a longer-term uptrend in momentum, although momentum is on the cusp of really giving way too. So the rate outlook doesn't look quite as strong as what it did at the beginning of May. Certainly going into May, it seemed like rates were going to probably move higher. It was one of the reasons why I thought rates were going to go to around 5.25. Certainly we were seeing movements to suggest that, but that just doesn't seem to be the case at this exact moment, with a chance for Treasury rates to break lower on the 2-year. On the 10-year, it's not all that much different. You have this trend line. Right now, you're sitting right on it. Tomorrow's CPI data is probably going to be pivotal because either we're going to bounce off of it and move up back towards that 466 area with the potential to maybe move up to that 5% region I was thinking we'd see, or we're more likely, or a weaker data point could send the 10-year down to around 442 and potentially lower than that. So again, this all will play into how we're looking at currency pairs as well. You can see that the euro has been sort of marching higher over the last couple of days. My thought process had been that we were going to see widening interest rate differentials, really supportive of pushing the euro down versus the dollar. And while it's still certainly possible with what appears to be a bear flag, again, the odds seem to be slipping because, again, it's going to depend on what the CPI data looks like. If the data is strong and it continues to support the idea that the Fed is going to be higher for longer, that the ECB is going to be the first to cut in June, that's going to be more supportive of the euro moving lower versus the dollar. Likewise, a weaker report would probably send the euro up, potentially even back to this 108.5 area, basically completing and removing all the decline that we saw starting in mid-April, and really putting into question whether or not there's a reversal pattern here at all anymore. And clearly a move down would probably lead to us undercutting this 106 area over time. But again, a lot of this is going to depend on how this CPI data point comes in. It seems like there's a lot riding on this. When you look at the British pound, it's a similar look. Clearly, again, here's the 50-day moving average. We're sort of hitting up against that resistance level again. A weaker CPI report could easily lead to the pound breaking out over 126 and potentially moving up much further than that. While again, a stronger CPI report potentially results in this moving lower as well. When we look at the yen, there's really not much here. We just have basically been sort of retracing some of the losses we've seen in the yen. Again, central bank policy there really isn't supportive of the yen really strengthening and seeing it move lower versus the dollar. But at this point, right now, the markets are sort of free to play. What would change this dynamic is if you started to see rates in the U.S. really start coming down, then that would again sort of go to this idea that you would see a weaker dollar and begin to see those treasury spreads with the JGBs begin to compress, and that would potentially begin to send the yen lower. And I would look for the first level of support again at this trend line, possibly in this 153 area, maybe at the lower end of the first round of intervention. When we look at the FTSE, we had talked about the potential for the FTSE to consolidate. That never happened. The FTSE just kind of continued to move up, so it's become more and more overbought. Although the reason why it's moving up again is because we know that copper prices have been moving up as well, and so the idea here is that, again, I think the FTSE is just basically trading with copper, and that's because obviously there's a lot of commodity players in the FTSE. So you are seeing the FTSE move up with some of these commodity prices as well. And so, again, it's important to note that the FTSE is sort of in this overbought area. Again, we did move up. We are starting to consolidate here, coming back inside the upper Bollinger Band. But again, the RSI is very high here, up at around 80. So we need to be mindful that we can still rally with the Bollinger Band. We can still rally with copper prices. But knowing that we're very overextended is something that we need to be acutely aware of. When we look at the DAX also did take out this high like we were expecting. You can see like the FTSE, we're trading above the upper Bollinger Band, coming back into it a little bit. We're not nearly as overbought. The thing that we want to watch here, you can see the bearish divergence forming between the RSI and the price action. So again, this looks like a spot where there could be some consolidation for the DAX based on this overbought condition, with the potential for a pullback to around the 20-day moving average, around 18,170. When we swing over to the NASDAQ has moved up. The NASDAQ is right now at resistance around 18,310. I had been thinking that we were potentially seeing a rising broadening wedge. That is still possible. There was a rising broadening wedge here, but now we've broken back above that trend line. So our big level of resistance at this point comes at this 18,300 area. After that, we're talking about, again, a retest of the old highs at 18,460. I mean, the NASDAQ at this point really isn't overbought in any way. The RSI is still very low and trending higher. The upper Bollinger Band still suggests there's room to go. So if you were to get a hotter print tomorrow that were to result in dollar strength, rates moving up, it would probably result in this NASDAQ coming down and potentially filling some of these unfilled gaps down here all the way down to 17,500 in the next couple of days. If you were to get a cooler report, you would imagine if you began to see rates really collapse and you were to see the dollar break, that would potentially mean that you would see the NASDAQ really move up from here. When we look at the Dow has basically at this point refilled the gaps that were left open. Those have been kind of serving as resistance at this point. We do have some of these unfilled gaps down here at 38,216 or so. Again, what we're kind of watching here is that we've broken RSI on the downtrend. So a lot of this is going to be dependent again on what the CPI report and how that looks. Again, if we get that report that comes in hotter, you're going to look for the Dow to probably break lower and such. And then finally, we're looking at the S&P. You can see the S&P has really just been respecting this trend line at this point, and so we need to continue to keep an eye on that. Again, it looks like we have a broadening ascending wedge here. It looks very similar to the one that we saw in the NASDAQ a couple of months ago that took a very long time to play out. So it's very possible that this is what we're in. And right now, what we've done is basically refilled all the gaps. It looks like this gap had already been refilled, but again, we're coming back up to it again from April 1st. Again, this would be our next level of resistance at 52,600 with, any sort of a break in the trend line that appears to be forming right along here, really helping to support the market. Obviously, if this were to break, you would start to see some of these support levels go. So we're going to keep an eye out for all of this as well. So unfortunately, a lot of the movements that we're going to see are going to be resulting from whatever the CPI report comes in at. Again, when we look at what the expectations are, they are for some pretty high readings. We are looking for the year-over-year numbers to come down. And if those numbers sort of come in as expected, that may be enough to push the market higher, just because they're not worse than expected. And so that's just the way the market's been operating these days. And I think you have to really keep that in mind. Anyway, have a great rest of your week, and we'll see you again next. Bye.